Welcome to the Wilber and Longenbaugh podcast, where we break down tax, accounting, and financial strategies to help businesses stay compliant, profitable, and prepared. Today, our mission on this deep dive is to show you how to turn on the headlights. I mean, imagine driving down a pitch black mountain road at 60 miles an hour, completely without headlights.
Yeah, that sounds like a disaster waiting to happen.
Right. You're forced to just react to every pothole or sharp turn only when it's literally inches from your bumper. So we're unpacking the essentials of financial forecasting today, using insights from the Wilber and Longenbaugh team to help you transform your raw financial data into a practical roadmap.
And, to ground this right away, the research really stresses that forecasting isn't just some rigid institutional spreadsheet reserved for, Fortune 500 companies.
It's for everyone.
Exactly. It's simply the mechanism of estimating future performance so you can prepare rather than panic.
But let's look at the reality for smaller operations. I imagine the biggest trap here isn't actively avoiding the forecast. It's more like treating it like a New Year's resolution.
Oh, for sure.
You build this pristine model in January, but then your data is completely stale by March.
Yeah, that set and forget it mentality is exactly what renders a forecast useless. The other major pitfall the research highlights is ungrounded optimism.
Like just making up numbers.
Pretty much.
Yeah.
Projecting a massive sales bump without historical data or market conditions to support it. People assume forecasting is just guessing the future. But it's not about perfect prediction. It's about reducing uncertainty.
Which makes sense.
And a small business actually needs this way more than a massive corporation because they have a vastly smaller margin for error.
Right, because a variance that a giant firm just absorbs with their massive cash reserves would...
It would completely derail a smaller shop. I mean, a small business is trying to figure out if they can actually afford a new hire next month. They need that data.
Yeah. Which brings up a really dangerous friction point. Even if a business owner updates their forecast flawlessly every month, they still run into a brick wall if they're only measuring profit and just, ignoring the actual timing of their cash flow.
Yes. It's the silent killer of successful businesses. There's a well-known industry statistic that roughly 82% of businesses that fail do so because of cash flow problems.
Even if they're profitable on paper.
Even then.
Yeah.
Because of accrual accounting, your P&L statement can create a really dangerous illusion of liquidity. You might close a massive, highly profitable contract in June, but because of net 60 terms, the client doesn't actually pay until August.
So you look fast on paper, but mechanically you're just seizing up. It's like knowing you're getting a huge paycheck on Friday, but you desperately need to buy groceries on Wednesday.
That is a perfect analogy.
Or like looking at your dashboard speedometer. That's your profit showing you're moving fast, but the cash flow is the engine oil.
Right.
If the oil runs dry in July when payroll and rent hit, it doesn't matter what the speedometer says. The engine just blows.
Exactly. The profit is your theoretical velocity, but the cash flow timing is what keeps the business physically running.
So, how do you actually map this out when the macroeconomic environment is constantly shifting, like inflation, supply chains, interest rates? Building a static model seems kind of futile when the ground is moving.
Well, that unpredictability is exactly why the Wilber and Longenbaugh team emphasizes scenario planning.
Oh, okay.
You don't just shave 10% off your revenue and call it a day. To build a robust model, you stress test your specific vulnerabilities. So for a conservative scenario, you calculate exactly what happens to your cash reserves if your two biggest clients suddenly delay payment by 30 days.
Or if supply costs randomly spike by 15%.
Yes, and you map out the exact trigger points where you need to freeze hiring or tap a credit line before the crisis even hits.
But none of those trigger points mean anything if your dashboard is broken, right? If your basic bookkeeping is a mess or expenses are misclassified, stress testing your model is just pure guesswork.
Precisely. Clean accounting is the absolute prerequisite. Forecasting shifts your operational strategy from emotional reactions to data-informed discipline. But, the math only works if the underlying data is pristine.
So ultimately, a functional forecast relies on clean data, a ruthless understanding of cash flow timing, and the discipline to consistently update and stress test your models.
It just replaces the panic of the unknown with a structured plan of action.
I love that. But before we wrap up, I want to leave you with something to chew on regarding that cash flow delay we talked about.
Okay, let's hear it.
If the timing gap, waiting 60 days for a check while bills are due today, is the silent killer of profitable operations, how might the rise of instant digital currencies and real-time smart contracts completely rewrite this rulebook?
Oh, wow, yeah.
Could the very concept of net 60 payment terms soon be an obsolete relic for your business? Definitely something to think about. Thanks for joining us on this deep dive. To get prepared and learn more, visit www.mwwcpa.com.